So I would like to introduce Karina Litvak. Karina is an experienced non-executive director, currently serves in 2 listed company boards, Terna, which is an Italian power transmission grid operator, and Enquest, a small North Sea operator specializing in the decommissioning of late life assets. Previously, Karina was also board member of an Italian oil company, Eni, for over 9 years. Karina is an ambassador and funding chairperson of the Climate Governance Initiative, which has been launched by the World Economic Forum, and that is actually an umbrella under which we all operate here. With Karina, we will have today also Maurits Dolmans, partner at Clarley, Gottlieb, Steen and Hamilton, LLP. Maurits focuses on EU, UK and international competition law, especially in the area of high-tech innovation and sustainability. He litigated before the European Commission and the EU courts, national courts, and national competition authorities in a number of EU member states and ICC and NII arbitrations. Maurits is a member of the Dutch and New York bars, and is admitted to practice in Belgium and in England. Marius also works, amongst other, with net zero legal teams and UN Race to Zero. So I would like our speaker to start the conversation. We will have a relatively flexible discussion. We have slides that will be shared later on, that to which we may, or Maurits and Karina will to refer to. But before we move on, I would like to add some housekeeping remarks on our today's agenda. We will have our event recorded. And also we expect to have our Q&A session at the end of the discussion. So please feel free to put your question on the chat. I will try to moderate, and if I will see any relevant question that will come out to during the discussion, I am also happy to jump in, so then you will be lively participating. Obviously, the questions on the chat or comments can be on the anonymous basis, so we are also feel free to see any anonymous questions, as well as questions from people who would like to introduce themselves. We have an hour. The topic is extremely broad, so I hope we will manage. So welcome again, and without further ado, I will give the floor to my colleagues, Karina and Maurits.
Thank you. Thank you, Lucina. And we're going to dive right into basically a Q&A that I will have with Maurits. And, by all means, if you have questions that are relevant to what we're talking about, do fire them into the Q&A, and we will do our best to incorporate them as we go along. So Maurits, boards, and certainly the people on this call, increasingly recognize that they need to act on climate change, but inevitably they run up against all kinds of obstacles, predominantly the sort of first mover disadvantage issue. This is a systemic problem by its very nature. And so they want to, well, some will spontaneously think of engaging in collective action. Others are pressured to engage in collective action from their investors and stakeholders. And at the same time, they are very nervous about that. So can you walk us through what is on everyone's mind and what should they be on the lookout for?
Well, thank you very much, Karina. So Rowan, if you can put up the slides with the graph. And what this illustrates is the problem of externalities. And I think you as non-executive directors will know about this. So I'll be very brief about it. The bottom line is when people, insurance companies calculate premiums, or when investors calculate return on investment, or banks calculate let's say the interest rates that they will charge. They take into account a variety of issues that they are aware of, like physical risk assessment, litigation risk. There are all kinds of litigations going on in the climate sector, and about 3,000 according to the Sabin Center. They'll think about directors and officers liability, and they think of regulatory risk of stranded assets. And that is all going to go into the calculation of your premium and your return on investment. But what is not included are, of course, the externalities, the damage to society. And you'll see that reflected in the graph as a result of the not including the social cost of climate change in the price of products or in premiums or in return on investments. There is an inefficient overinvestment. And as Nicholas Stern, Lord Stern now, already wrote in 2008, greenhouse gas emissions are externalities and represent the biggest market failure the world has ever seen. And he then explains that people around the world are already suffering from past emissions and that future emissions can have catastrophic impact. This is crucial because whenever we talk about antitrust law later on, the recognition that climate change is caused by these externalities, by these market failure, is crucial because it is the basis for the argument that antitrust law allows agreements to deal with these market failures. If there's one thing to remember from this presentation, it's that point. Antitrust law now allows, and in the US even arguably allows, it's still a little unclear, but we'll talk about it, agreements and cooperation to deal with market failures. Now, the damage to market failures of these market failures to society is enormous. Just to give you an example, if you can see this is a very interesting article written by a number of some scientists from Columbia University and Oxford for the IMF, and it calculates the total cost to society of current and future coal combustion. And we're just talking about coal, not oil and gas, just coal. And they calculate this, and it's actually arguably a conservative calculation, of $114 trillion. So the cost to society is enormous and much larger than people realize. The cost to society are, of course, the cost of climate change. And in case of coal combustion, you also have medical costs associated with fine particle emissions and so forth. But the key point to keep in mind for this particular example is that the costs to society are enormous and much greater than others. And so what we do matters to society. If we insure or invest in coal, others will do so too. And that means the world will overshoot the carbon emission budget. Now, this is not just a question of the cost to society. And this is something that I'm not, people that I discuss this with tend to kind of be a little bit surprised, but it's not just a matter of cost imposed on society. These costs also affect our own investments and our own investment portfolios. Obviously, there are the direct risks associated with financed and insured emissions, like reputational loss, litigation, and so forth. But there is also risk to other assets. Many of the investors and insurers on this call work with insurance companies or asset investors who are universal asset owners. They own assets that are a part of every sector in the economy and even every geography in the world. This is done in order to spread risks, but obviously it is also in order, well, it's to spread risk. But the consequence is that we can't diversify our way out of the climate crisis. Effectively, if you insure or finance a coal power plant, it's going to have negative impact on other assets that you own. So, for instance, There could be extreme weather events, there could be fire, there could be flooding, there could be wind, there could also be social, societal disruption and economic disruption caused by climate change, and which affects those other assets. So one thing to keep in mind, as a universal asset owner or a universal insurer, this is going to affect not only society as a whole, but also your own investments. This causes, in turn, long-term existential risks. We are all aware of stranded assets and regulatory risks, but we already see the existential risk of these climate change events happening. There are uninsurable assets. You will recall that State Farm now refuses to insure personal and business property and casualty in California because, and I quote, of the rapidly growing catastrophe exposure. And Standard & Poor's found that reinsurers underestimate their exposure by as much as 50%. And that's reinsurers, and there aren't that many of them. Now, Fitch Ratings, another one, concluded that global reinsurers, as a result, are starting to cut back on catastrophe cover for this reason. And so that could affect the entire insurance sector. So all of this is obviously relevant for our fiduciary duties to our shareholders, to customers and beneficiaries. If we can have the next slide, please. It'll give you an example of the Dutch Corporate Governance Code, which explains that that as directors, we have a fiduciary duty, this is a matter of Dutch law, not only to our shareholders, but also to our employees, to our customers, to our clients, to our beneficiaries, and as you can see from this quote, even to the environment, and we have to take into account the impact of our activities on the environment as a whole, and that includes the climate. Now, these rules on fiduciary duties, they differ from country to country. If we can have the next slide, please, you'll see, for instance, Section 172 of the UK Companies Act. That too says, and I won't have time to go through the whole provision, but it basically says that in principle, the directors have to take into account the benefit of the members, that's the shareholders, but they have to have regard in doing so to a whole variety of issues, the long-term impact on the company, the interest of company's employees, but also the impact of the company's activities on the community and the environment. Now, this was the subject of the famous Shell litigation. It was a cause of action brought under derivative action brought against the directors of Shell in the London courts. And the London court decided that no, this is going too far. You cannot claim that Shell, in not having a proper transition policy to a sustainable activity, you can't say that that is a violation of their fiduciary duties, because that is for the directors to decide and not for the courts to review. And the court will only review it marginally, that is to say, whether a reasonable director could come to this particular conclusion. But I think there are two comments to be made. One is that surely it's not in the benefit of members and shareholders and their offspring. I mean, think about your children and your grandchildren, that the environment and the climate in which the corporation operates is harmed to such an extent that the economy and society are destabilized, and that now societal and economic disruption could ensue that could endanger the company's long-term existence. So I think that two conclusions to be drawn. First, this litigation is not the last word on this point. The law is evolving in various countries. Claimants will continue to persist in bringing these cases. And just like the tobacco litigation and the asbestos litigation, eventually they will start losing. And it is better to be ahead of the curve to avoid that. And second, this fiduciary duty is also to non-emitting clients, the ones that are affected by the emissions resulting from the financed or insured high emission activities. Sorry, Karina.
No, I apologize. No, I mean, I think you've made a really convincing case for the strong economic case, compelling economic case for why directors need to take action. And yet at the same time, what I'm hearing, for example, from colleagues in the banking sector, and especially actually banking, insurance, and asset manager across the board, they are being told to dial it down. They are being told to take a low profile and to stay out of public view, particularly on collective action, for fear of attracting the wrong kind of attention from some political leaders, from the so-called anti-woke backlash, the anti-ESG backlash. So could you tell us a little bit whether that is a genuine fear? In other words, are directors right to be worried about this? And what can they do?
Yeah, when discussing this, I kind of hear three things. The first thing is, and maybe we can see the next slide, Rowan. The first thing I tend to hear is, well, wait a minute, we need energy security, we need supply security. We cannot just cut down on fossil fuels, because fossil fuels are going to be with us until 2050 and after, and if we cut them now, we're going to be in trouble. And actually, and that's what this slide shows here, the roadmap for global energy by the International Energy Agency. And the IEA has come to the conclusion that we can cut investments in new fossil fuels. And they also say we have to, because otherwise we miss the carbon budget and we are going to have these climatic disruptions. And second, we can, because if you look, and they have studied this in great depth, if you look at the supply security through 2050, with the transition, there is no need for new coal or new oil and new gas in investments. That's the first one. The second answer I hear is, okay, why should we stop investing in oil and coal and gas or insuring these projects? Because if we don't, other people are going to do it. So we'll just give up an opportunity, we'll give up market share, other people will grow their market share, and we just lose out. And of course, one answer to that is, wait a minute, those who invest will probably end up with stranded assets. But more importantly, is that, and if you can have the second slide, this is a traditional collective action problem. The idea that I'm not going to act, even if I know it is in my interest, unless you're going to act. And you're not going to act, even if you know it's going to be in your interest, so long as you don't know for sure that I'm going to act. And that is a traditional, a classic collective action problem, or a prisoner's dilemma. Everybody who invests, finances, or insures new coal damages not only themselves, but also each other. And no one is going to stop until everybody stops, even if they want to stop. And the only way out of this, and this is the third thing, is regulation or coordination. And that can be various types of regulation. You can have straightforward regulation forcing companies to reduce emissions. You can have emission trading rights, you have carbon taxation, and so, but the problem with regulation is that it is clearly inadequate. So we have a combination of market failures and regulatory failures. And so the only solution to that is cooperation. Cooperation between companies where they tell each other, let's jointly stop investing in new coal, for instance, because that is the only way to avoid this collective action problem. And then, as you say, Karina, and it's probably your next question, I imagine, is, well, wait a minute, what about antitrust, right?
Exactly. I mean, that's what weighs on the minds of many directors, is that if they are perceived to be engaging in collusive behavior, if it is perceived that they are depriving certain industries of insurance coverage, of funding, are they going to run into legal difficulty?
Yeah. If you can have the next slide, please, because that issue has arisen. There is, in particular in the US, we don't really see this in Europe, and I'll explain why, but particularly in the US, a number of attorneys general who tend to be from mid-American states and southern states, they have raised objections. They say, wait a minute, the withdrawal of finance and insurance from new fossil fuel projects and I quote from this particular letter, has led not only to increased insurance costs, but also to high gas prices, high cost for production, resulting in record-breaking inflation and financial hardship for the residents of our states. So I didn't know that, economists don't know it, but apparently the inflation is caused by companies deciding no longer to insure or invest in fossil fuels. It's wrong for a variety of reasons. First of all, because actually the existing net zero alliances don't require companies, their participants, to cut insurance or investments in new fossil fuel projects. So there is actually, they don't go far enough, I would say. They don't actually do it. And second, as a matter of law, there is no justification for this position. Or at least certainly in Europe and the UK, no justification, and the US, very likely no justification. If we can go to the next slide, the next slide gives you a quote from the EU guidelines on sustainability agreements, because in the last 4 to 5 years, the European Union has discussed this question of, okay, market failures, regulatory failures cause climate change, therefore cooperation in the private sector should be allowed to the extent reasonable and necessary in order to help mitigate the climate crisis. And they have therefore adjusted the guidelines on agreements between competitors. That's what horizontal agreements are, agreements between competitors, say agreements between insurers, agreements between banks, agreements between asset owners, pension funds, and so forth. And they say agreements that are in principle allowed, that serve the objective of mitigating climate change and that are reasonably necessary to that end, and that includes agreements no longer to insure fossil fuel, new fossil fuel projects, and those are allowed. So there are a variety of arguments, of agreements that are covered by this. If we can go to the next slide, for instance. This slide gives a number, or lists a number of agreements which now are clearly allowed. So there's no longer any debate in the EU and the UK, and for many of those also not in the US, that are clearly allowed. For instance, getting together to jointly lobby the government to adopt regulation or to adopt carbon taxation or to expand the scope of emissions trading rights, joint lobbying is clearly allowed. Also in the US, it's constitutionally protected under what's called the Noor-Pennington Doctrine, and it's clearly allowed. Voluntary codes of conduct are another example. Voluntary emission reduction targets, leaving the companies free to decide how they are going to implement them. There is a soft safe harbor for standard setting, so how to measure emissions, for instance, and so long as that standard is voluntary, it's covered by the soft safe harbor. If it's mandatory, it may need an exemption, and we'll come to that in a moment. But a very interesting one, which is new, is joint shareholder stewardship cooperation. So asset owners may want to get together and say, well, this particular company in which we jointly invest, it doesn't have a proper transition plan. We think that damages the other assets that we own. Therefore, we want to encourage this company to have a proper transition plan. There were arguments in the past that kind of cooperation would give rise to antitrust issues. It is now explicitly listed as a kind of agreement that is not an antitrust issue. So Climate Action 100 Plus or Share Action and all of these organizations basically are okay. There's some guidelines, some guardrails. You can't then become a collusion point for collusion between those companies, but nobody is even thinking about that. So and those guardrails will be explained in the slide deck that you will get afterwards.
And Malcolm, it's this removal of the kind of shadow over joint investor action. Are you saying that applies across the US as well as Europe and the UK? So
so in the EU and the UK, it is now clear under the guidelines that it is not covered. In the US, antitrust law is effectively the same as in the EU. But in the US, it has to be said that a number of these attorney generals don't like joint shareholder action, and they have written letters to, for instance, I think Climate Action 100 Plus, if I'm not mistaken, saying, well, that's an antitrust issue. But if you look at it, that is not an antitrust issue, because it is not cooperation between competitors in order to reduce competition. It is cooperation between shareholders in order to cause in their own interest and in the interest of the other assets in society as a whole, to encourage transition. And if it later turns out that this is not allowed under US antitrust law automatically, I think it still qualifies under the rule of reason. And we'll come to that in the next slide. If we can have the slide with the orange light, right? We have the green light, now the orange light. The orange light gives you a list of examples which in the EU and the UK are potentially restrictions of competition, but where you can analyze those agreements and come to the conclusion that the benefits to society and to the parties of these agreements in terms of climate crisis mitigation outweigh the negative effects on consumers of these agreements. For instance, you can have a situation where you can have a phase out of unsustainable products. And the typical example always called is the SESAM case, which was a number of washing machine manufacturers, and they agreed to phase out the least efficient washing machines that soaked a lot of water and electricity. So they phased them out together. Normally that is a problem under antitrust law, but the European Commission looked at this case and said, well, first of all, there are benefits to consumers because the new machines are a little bit more expensive because they're more efficient. But the higher costs are outweighed by lower water consumption, lower electricity consumption, and lower detergent consumption. And that outweighs the cost increases. And then the Commission went further, and that kind of thinking is still allowed in terms of climate agreements as well. They said, but the benefits to society are 7 times the cost to the consumers who buy these things. Therefore, we're going to allow this agreement regardless, even regardless of the individual benefits to consumers. So that's an example of the kind of balancing act that you can see also in climate agreements and other environmental agreements that arguably restrict competition, but which have much greater benefits to consumers and to society as a whole. Other examples are phase out of unsustainable inputs. So in other words, to buy only from suppliers who are sustainable or green, to jointly market or jointly develop sustainable products that previously didn't exist. Agreements not to provide services to customers who are then using them, or products to customers who are then using them to engage in very high emission activities. And that leads us to the kind of agreements that have been most criticized in the US, agreements not to finance or insure new high emissions activities like new coal projects or new fossil fuel projects, right? They are controversial in the US, but there is a balance possible there. Sorry.
No, I just want to test this because is there any kind of quantitative test whereby, let's say my company produces something, let's say fuel for cars, right?
Yeah.
And I persuade my competitors that we should all stop selling, traditional petrol, gasoline, and only sell biofuels. And that has a significant price impact, significant. Is there any quantitative tests that we need to pass to demonstrate that this is in the interest of society, even if the cost to consumers is objectively going to be higher? Because how far does this go before, if we only rely on some sort of qualitative argument, how far does this go before there's a counter action that says, wait a minute, this is just not sustainable. It's not proven. It's not grounded in the facts, and you're hiding behind the argument of public interest, but it's not demonstrated.
Yeah. I would say that agreement probably goes a little bit too far. If you go to the next slide, you'll see the kind of balancing test that you have to go through. So the first step would be to say, okay, is there a market failure? And in this instance, there probably is a market failure, right? Because consumers are probably not willing to pay for cleaning out fuels, not sufficiently. As a result of that, unsustainable production continues. There is a market failure. And then you ask the question, okay, what is the balancing test, the benefits against the disadvantages? Now, I think that in this particular instance, a complete immediate stop of say, for instance, fuel for cars, that is going to probably increase the price more than the benefits to consumers. That argument will be made. So what you need to do is to look at the price increase to consumers. And in this particular example, the price increase to consumers will be quite substantial because they won't be able to use their cars anymore, and that needs to be a gradual transition rather than an immediate transition. But and a gradual transition to electronic cars, to electrical cars, for instance. So you'll see that already in regulation, because the UK, for instance, is or some countries are already planning to say, well, in 2030 or 2035, there should be no new internal combustion engines sold, right? So that is an example of a gradual transition. But what do you do in such an agreement? You calculate the net benefits to the consumers who buy the cars. You discount those net benefits because those net benefits may arrive in the future. Although the climate crisis is getting awfully close for a number of consumers, so the discounting is probably not that great anymore. And then you balance that against the cost increase to consumers, and the benefit in principle has to outweigh the cost. If the benefit does not outweigh the cost, you'll have to make a second argument and make sure that, okay, this has to be purely climate related, in which case the European Commission and the UK Antitrust Authority will also take into account collective benefits to other citizens in the EU or in the UK. Even so, I would suspect that for the example you mentioned, it's probably going to have to be a gradual transition and not an immediate one.
Okay, but so there are limits on this. It's, in other words, the moment you invoke the public interest argument, you need to be careful about how far you push it before it boomerangs on you, and then you've lost the argument.
Yes, yeah. So what you see in this decision tree, you see in step 3, right? You have to apply the so-called rule of reason or exemption criteria, and one of them is, does a fair share of the benefit come to the consumer? And the EU translates that a little bit more rigidly than the law requires. They say that the benefit to the consumers has to outweigh the cost to the consumers. But you can quantify these things. Economists quantify them all the time. Environmental economists have done this for decades. And there are various ways of quantifying it. You can look at, for instance, emission trading rights. What's the price of a ton of emissions in the EU? Well, probably around, I didn't look at it this morning, but I imagine it's 70 to 80 euros. And it's going to go up every year because that reflects the emission trading rights systems and the gradual expansion of these systems. You can also look at the social cost of emissions. What's the damage that's going to arise in 10, 20 years? And then you discount it by whatever a reasonable inflation percentage is, and you calculate the net present value of that future damage. And you say, okay, the benefit to consumers avoiding that net present damage must be greater than the cost to consumers. Another way to look at it is, okay, what is the so-called avoidance cost? How much does it cost to avoid these emissions? And then see whether that cost is lower than the cost to consumers.
Okay.
So there are various ways of doing this, and economists have done it for ages. And the Commission and the UK Antitrust Authority don't necessarily require a quantification if a broad approach actually suggests that is very likely to be met.
Okay, 5-minute warning, and then we're going to do Q&A, and then with Luciana. So,
okay, well, there's perhaps the next slide very, very briefly to show that this is not to say that all climate agreements, all agreements that are cloaked under a climate objective are therefore allowed, right? The antitrust authorities give us a hand, but you can't take the whole arm. So, for instance, you can't do price fixing. You can't agree that, okay, we are all going to calculate the climate cost of our emissions, and we are all going to do a surcharge together of that amount. What you can agree is to have an internal cost but each individual company should be allowed to decide for itself whether and how much of that is going to be passed on to consumers. There must be no coordination between market participants. So, for instance, in insurance companies getting together, they can decide that they will all calculate internal cost of climate change and take account of that in their internal decisions. What they cannot agree is to add that to the premium. That is a matter of unilateral decision. You can't jointly agree and jointly require to do that. Every company has to decide that for itself, and they have to compete on being more efficient. So there are other examples of things you can't do. Car manufacturers got caught by basically agreeing to dodge regulation. This was the AdBlue case about diesel emissions. I won't go into the details unless somebody wants to, but they tried to all agree, let's just look like we are complying with the legislation, but all have smaller tanks for AdBlue because that saves us money, and so they were caught and got very, very high fines. So that's why the traffic light system works. Green light for agreements that in the past weren't allowed but now are clearly allowed. A red light for agreements that were never allowed and won't be allowed in the future. And an orange light or an amber light for agreements which weren't allowed in the past, but if they can be shown to have benefits that outweigh the costs to society or to consumers, depending on whether it's a climate agreement or not, they pass muster. And by the way, that also works in the US. And this is why these attorney general letters are wrong. They say these kind of agreements between insurance companies, between banks, between asset owners and so forth, or between, they are per se violation of antitrust law. You get a big fine, there are damages, you may even go to jail. That assumes that those agreements are analyzed by the courts as so-called per se violations of which always have bad effects and never are justified. When you actually look at the case law of the Supreme Court, and there's an article that will be distributed to this group afterwards, the Supreme Court case law says these per se violations only apply to collective boycotts which are designed to exclude competitors. They are not designed for collective agreements not to supply or not to service or support customers who are causing damage to you and to society as a whole. That is analyzed under a rule of reason, and that rule of reason follows the essence of that decision tree that I showed earlier. So if you can go to the next slide, because I think we need to come to a conclusion. Right, Karina, any questions now, or shall I conclude? Because
I think go ahead with the conclusion, and we'll take questions from the audience.
okay, so the conclusion is set out here. We have a choice as companies, right, and as directors and as non-executive directors looking at our various boards. Doing nothing and saying nothing, I don't think is an option, because it leads to climate risks, damages to your other assets, to litigation, and to even existential risks.
Can I just interrupt you right there? Is there a risk to directors? Can we be considered to be deficient or negligent in our duties for doing nothing?
Yeah, so well, that comes back to the question of fiduciary duties and the corporate interest. So, for instance, in the Netherlands, there was a case against Shell, and it's the Shell case, which is on appeal, so we don't have the last word on that. But the Dutch court said to Shell, wait a minute, your transition plan is not good enough. And what you are doing is tortious conduct. It's just like a tort. And tortious conduct is basically causing damage to other people, right? You are not meeting your duty of care to society, to your customers, to your competitors, to your suppliers, and to society as a whole. because the absence of a transition plan means that you are going to cause climate damage to everybody. You have a duty of care to stop that under tort law in the Netherlands. They didn't say, I'm imposing damages on you. That's maybe for later. They said to Shell, adopt a proper transition plan. And Shell has to do that now in the Netherlands. And so Shell can be liable. Now, the NGOs, climate NGOs, then wanted to take that a step further. They sued the board of Shell in the UK, the board, the individual board members. And they said, board members, you have not implemented the Dutch judgment. In addition, you have an obligation under that article that I showed you earlier, 172 of the Company Act in the UK, because Shell is in the meantime moved to the UK and no longer subject to Dutch law. You have an obligation towards society, not only to your shareholders, but to society as a whole, to take into account their interest. And by not adopting a proper climate plan, transition plan, you are not only violating the Dutch law, you're also violating your duty of care to the fiduciary duties to other shareholders. The UK court shot that down. The last word has not been said on that, however, because I think that this is going the same way as the tobacco litigations and the asbestos litigations. The first round, the claimants lost. Eventually, they persisted. There is a litigation pending in California against all the large oil companies. That litigation is, I think, going to be a milestone in the in this area, because the state of California says, look, oil companies, you have known from the 70s that these damages were going to incur. You have made scientific calculations which were extraordinarily good at the time and are still valid and are borne out by IPCC predictions. In fact, and therefore you have knowingly caused damage for 50 years to society. You will have to compensate us for that, and you have to pay for our transition plan. I have no idea how that litigation is going to end up, but if the tobacco and asbestos litigations and other large tort claim litigations are anything to go by, eventually one of those actions will succeed. And there are, according to the Sabin Center, 3,000 pending in the world right now. So, and that's in addition to the existential risk, right? There is, I think, a quote from a CEO of AXA saying, with a 2-degree climate increase, insurance is going to be very difficult. With a 3 to 4 increase in temperature, insurance is impossible. We won't have a business anymore. And so that's the existential risk of doing nothing.
Well, indeed. And, to your earlier point about these universal impacts, these spillover impacts on
Yes.
The other insured customers, on the other shareholders, and you talked about the duty of care to shareholders.
But also duty of care to your other customers. And
to your customers, exactly. Has the argument been made in the Shell case or in similar cases, or do you think there's a risk for directors that they could be held accountable for failing to take into consideration the impact that their company has on other stock values, on other insurable clients? In other words, we as directors in the boardroom, we talk about shareholder value in terms of the value of our share. Mm-hmm. But at what point are we held responsible for the spillover effects of our company on the share values of other companies?
Yeah, I think that is an issue which has not been given sufficient thought in litigation yet, and I think eventually will arrive. Imagine an asset owner or an investment fund with 2 funds. One is a coal fund, and it unambiguously and unashamedly invests in lots of new coal projects and lots of new fossil fuel projects. And there's a second fund, which is, let's say, a green fund that they run, but it is invested in an area which is subject to climate risk, say in a geography that is subject to flooding or to high extreme weather events or to wildfires. or basically other risks emerge, which cause societal and economic, and there could be an economic crisis as a result of these kind of things. So people don't think about the fact that entire regions of the Earth, the equator, are going to become unlivable when temperatures exceed 40 to 50 degrees, and the human body is no longer able to cool down, and people are going to flee. So we think we have a refugee crisis right now. Wait till climate crisis really takes off. So the societal and economic impact of that could be very, very substantial. And I can see the owners or the investors in that second fund saying, wait a minute, we are being damaged because of emissions from that first fund.
Yeah.
And who is running our funds? The company, the investment company. So we're going to sue the investment company for breach of fiduciary duty, for tortious conduct, because the insured or the funded emissions cause damage to our investments. And that is a kind of an example of how that might play out. There are many other examples how it might play out, but that is something to keep in mind.
Okay.
Yes. It's fascinating discussion, and I think we can probably continue for quite a while. I just didn't want to interrupt earlier, actually, because some of the questions are quite general. And they are a few. We have 10 minutes, so I will maybe quote one or two, adding maybe some of my thoughts that actually I was thinking of the same question. One of them is, I quote here, did you mention that net zero initiatives go into green zone? I am not sure if the EU and UK guidelines are clear on this point. And I would actually wanted to add here whether you can comment on any fundamental differences between the European Union and the UK approach.
Mm-hmm.
I think there's lots of similarities when it goes to the net zero agenda. However, the EU seems to be far more advanced or regulated, I would rather use the word, when it comes to the implementing the EU Green Deal, the Finance Initiative, and a number of regulatory changes that go with it on all fronts, on net zero, carbon trading, rooftop regulations, and so forth. So yes, summarizing, our green initiatives sort of by definition green in the traffic light, and I guess you mentioned, or maybe I have seen it in your earlier presentation, when this is really may not be the case, even though it can be considered as green. And the second part of the question is some sort of comparison where the EU, with its extremely strong focus on sustainability, differ or does not differ from, and the good example is the UK approach, but if you have other legislation also regimes to add, it would be great. And I'm not sure we'll have time for more questions, so let's focus on this one because I think it's quite important.
Yeah, so when you see the traffic light slides, so there are a number of green agreements which are clearly allowed. For instance, joint shareholder action, unless you go beyond what is reasonably necessary, that's allowed. Then there's the amber light category, and the amber light category includes, for instance, the agreement not to finance or insure new coal power plants, right? That's by way of example. And it's very interesting to see that the UK antitrust authority has explicitly listed this agreement as one that is likely to qualify for exemption. So the amber light means it'll probably pass. But at the same time, the antitrust authority says, if you want to agree on that, kind of knock on our door. We invite you. We won't fine you if you do it. We won't, and we will work with you. And we may even issue a so-called exemption decision or a guidance or an informal letter saying, yes, we have looked at this agreement and the benefits to consumers outweigh the cost to consumers, and therefore this agreement is allowed. And the fact that they have listed this explicitly gives already a hint that they think that this is likely to be allowed, that this ad hoc assessment of balancing cost against damages against benefits is likely to end up in the green area. Now, how do the UK and the EU differ? The EU and the UK have a slightly different approach. The EU has a broader range of sustainability agreements. They look at all potentially 17 UN social development goals. So and the UK says, well, our guidance is limited to environmental sustainability agreements, and that includes pollution, biodiversity, and climate change. And then, so the UK is narrower in scope than the EU, but they go a little bit further because they say for climate change agreements, we look at the benefits to all UK citizens and not only to the benefits to the citizens who are buying the product in question. So they are a little bit more liberal. I think the EU will actually, when they do the assessment, come to the same conclusion, because in particular, when you talk about electricity generation, everybody buys electricity. When you talk about oil and a car fuel, so everybody buys that. So in the end, I think the EU analysis will be as permissive as the UK. Now, the third question you raise is, okay, what about regulation? Because the EU Green Deal has a lot of regulation. We have reporting requirements, and we have disclosure requirements, the emission trading rights system. You have the Corporate Sustainable Due Diligence Directive, and it's true. And if this regulation were fully effective to prevent the climate crisis, then cooperation would no longer be necessary and would no longer be allowed under EU law. But this regulation is limited in geographic scope. It applies to the EU only, and it's limited in the scope of the economy. Emission trading rights apply to, 30, 40% of the economy. That means that the other half of the economy is not covered by them. And the same goes for these reporting and disclosures. No, reporting and disclosure is all nice. Doing due diligence is all nice, but that doesn't actually solve the problem. Now, because the idea is with reporting and disclosure, the market will solve it, but the market may not fully solve it. So the Corporate Sustainable Due Diligence Directive says a third thing. They says you actually have to take action to mitigate the climate crisis. It's a provision in the Corporate Sustainable Due Diligence Directive, which is often ignored, but a very important one. And it also says, if necessary, you have to cooperate with your competitors in order to achieve this goal of mitigating the climate crisis. So you see that even the regulation recognizes that it may not be enough and that private sector cooperation may be necessary. I hope that answered your question.
Yes, I think it's, very, very relevant. There was one more question that probably was asked somewhere during our conversation a bit earlier. I will just quote it. I'm not 100% sure I understand the exact, let's say, inquiry, but let me read it. Is it not the case that every institution that finances investment in non-renewable sources must have its own reinsurer with significantly more capital? Could it be that in practice this may not be viable in the long run in the EU? I think it refers to the earlier conversation that we had about the financial institutions. So this would be the last question. So if you don't mind also answering.
Yeah, no, there will be people on this call who know a lot more about insurance and reinsurance than I know. But what I have seen in my practice and in the debates about this is that reinsurance companies, insurers must have reinsurance in order to spread the risk of the particular projects that they have just insured. And if they don't have to, they want to, and for all kinds of regulatory reasons, they may have to. But reinsurance companies aren't required to reinsure everything. And so they are starting to realize, and that is the what was it, Standard & Poor's and Fitch and so forth, the numbers that I mentioned, they're starting to realize that they are overexposed, that they have underestimated the risk of catastrophic events. and therefore they are starting to cut back on catastrophe insurance, in particular apparently in the mid-range rather than in the high end. And they're starting to realize that many of these insurance companies, including reinsurance companies, they calculate and they estimate their risk based on past events and past damages, and then they extrapolate into the future. And with climate change, they may be extrapolating, okay, that there's an increase. But what people are starting to realize now, that the increase of risks associated with climate change is not linear. It is exponential, and potentially even more than exponential when tipping points are reached. And you know all about tipping points and cascading risk, but where you have a situation where suddenly one risk materializes, say, for instance, a lot of permafrost in the Siberia melting and causing uncontrollable emissions of carbon dioxide and methane, and that may cause, you know, further damages to, say, for instance, the Amazon region. We already hear this summer that the Amazon is drier than it's been for 120 years, and it's causing enormous strain, and it causes the Amazon to be a carbon emitter rather than a carbon sink. Yeah. So if these things happen at the same time, you get cascading risk. So it's no longer a linear increase or whatever from your perspective, but it could be a exponential or even stochastic increase. So and the insurance companies and reinsurance companies starting to realize that. If then the reinsurers, and that's a very concentrated market, withdraw because they have to, because they can't afford it, then insurance is going to withdraw, and you will have this problem of entire areas like Florida and California and so forth no longer being insurable. Entire sectors of the countries or economies no longer being insurable. That is going to cause, eventually it'll fall back on the taxpayer if the economy allows. Yeah. But this could have all kinds of cascading risks.
And again, the challenge for us sitting in the boardroom is what individual actions can we take in our one company? And it can be quite complicated to interpret everything that you've just said, which is, you know, makes a really compelling economic case for why action is needed. But then, you know, we then need to develop new products, perhaps retire existing ones, change the way that we engage with clients in a way that, you know, fortunately the law is now moving in the direction of helping us do this, and that's a very positive. And I think the main takeaway from this discussion is that we as directors can go back into our boards and engage with our management to say the picture is brightening, at least in respect of what we're allowed to do, as well as the pressure that we're going to come on under for not choosing to do it.
Yeah. Yeah, I would say have a look at that traffic light, and certainly the green light is something you're allowed to do. And I think you should do because of the climate risk. So lobbying the government and doing that together, agreeing on standards, agreeing on emission codes of conduct, targets, and exercising your voting rights in your investee companies to make sure that they have an appropriate transition plan. Have your own proper transition plan, and then all of these things are allowed. And then look at the amber light. You can do everything in the amber light you can do unilaterally. So, for instance, put pressure on your suppliers to have a transition plan and say, if you don't have a transition plan, we're going to move to other suppliers who do have a transition plan. The same for your customers. If we are insuring you now, but next year, if you don't have a proper transition plan, we're going to no longer insure you. So please present us with a proper insurance plan. You can do that unilaterally, no problem at all. And you can probably also do this together as a net zero alliance, in which case get legal advice or talk to your legal service. And if need be, go and see the antitrust authority, because they are very, very eager to clear these kind of agreements. They want to do this. So, and that includes a unilateral decision to say we are no longer going to insure new fossil fuel projects because we know they're causing damage to our other assets, and we may be exposed to litigation in the future. And but second, then also let's agree amongst each other that we won't do this or that we will phase this out. And before doing that, go and see the antitrust authority and have it blessed. We have a project for this, for Race to Zero, on how to do this. Everything is ready. So anybody who is interested in this can join that project. And it doesn't have to be, it can be privileged and confidential. So and there are lots of things you can do, everything you can do unilaterally, and together you can do everything on the green list, and with proper legal advice, everything on the orange list.
That's really,
Yes,
that's
thank
takeaway
you.
for all of us, isn't it?
Exactly, I agree. I think we are getting to the end of our session. I would like to thank you both for excellent discussion. There's lots of information. So I think we will find some of the details in your presentation. I think this topic will for sure evolve in a number of directions. I have no doubt about it. So at this moment, very big thanks for fantastic conversation, and I'm glad it's recorded, because then you can also have a look at it again and digest. So thank you so much.
And thank you, Lucina. Thank you.
Thank you very much,
Thank
Lucia.
you. Bye bye.